You study the chart, you predict the exact direction the stock is going to move, and the stock actually moves there. But when you check your account, you still lost money on the trade. This happens because new traders tend to look at options through only one lens, the dollar amount attached to the contract. They see a chance to grab cheap leverage or a way to collect a fast upfront premium. If you are selling options, that usually means chasing the highest premium on the board. You collect a lot of cash on day one, completely ignoring the structural risks built into that specific strike price. If you are buying options, it means hunting for the cheapest possible contracts to maximize your leverage. You buy a pile of them, completely ignoring the math that virtually guarantees those contracts will expire worthless. Treating options strictly as price derivatives is a reliable way to slowly drain an account. Sustainable trading requires looking under the hood and understanding the underlying probability math. That math is governed by delta. Delta is a 3-in-1 dashboard that measures your exact probability and capital efficiency. First, the dashboard shows statistical probability. A 20 delta option has roughly a 20% chance of finishing in the money. Second, a directional speedometer. A 40 delta contract moves 40 cents per dollar. Third, share equivalence. A 50 delta contract behaves exactly like holding 50 shares. You have to evaluate these three metrics together. When you do, they expose the actual risk profile of a trade before you ever click execute. Once you define whether you are going to be a buyer or a seller, these three lenses tell you exactly which strike price is mathematically optimal for your goal. When you sell an option, you are collecting a premium. Your primary job is to balance a sustainable win rate against the return on the capital you deploy to hold the trade. The first trap sellers fall into is the 30 to 40 delta zone. The upfront premium here is massive, which makes it incredibly tempting. But a 40 delta means you only have a 60% probability of winning. That creates a dangerously tight margin for error against normal, everyday stock fluctuations. It also exposes you to gamma vulnerability. Because you are so close to the current stock price, even a minor adverse move causes unrealized losses to spike rapidly, forcing you to defend the trade almost immediately. Sellers get burned there, so they swing to the opposite extreme, the 1 to 5 delta zone. They target a 95 to 99% win rate, assuming it provides absolute safety. This diagram outlines the problem with that approach: severe capital inefficiency. You are tying up $1,000 of collateral to collect a tiny $5 premium. That destroys your return on equity. Over a long enough timeline, both extremes fail. The 40 delta zone guarantees frequent, painful drawdowns. The 1 delta zone exposes you to asymmetric tail risk. You win a few dollars for months until one unexpected outlier event wipes out your entire year of gains in an afternoon. To build a sustainable portfolio as a seller, you have to move to the middle ground. The practical sweet spot sits in the 15 to 20 delta zone. This standard bell curve maps stock price distribution. Targeting the 16 delta positions you at one standard deviation move, securing an 80 to 84% probability of success. This provides a structural cushion. The stock bounces through normal volatility, while your strike remains safe. The 15 to 20 delta zone is the specific area that historically balances a high frequency of winning trades with optimal capital efficiency, keeping your drawdowns entirely manageable. Option buyers have a completely different motivation. They want maximum directional exposure and high leverage without tying up a lot of upfront capital. That drive for cheap leverage leads straight into the lottery ticket trap, buying far out of the money options in the 10 to 20 delta zone. This chart plots cheap contracts nearing expiration. The math is brutal. Buyers here lose 80 to 90% of trades. The culprit is theta decay. Because out-of-the-money options are entirely extrinsic value, time erodes the position. Every day, the contract bleeds value. To overcome that decay, the underlying stock has to move significantly, and it has to move immediately in your direction, just for you to break even. Moving up to the 50 delta, or at-the-money zone, improves the odds to a 50-50 coin toss. But these contracts have the highest extrinsic value on the board, making them hypersensitive to time decay and sudden drops in volatility. Prioritizing cheap leverage mathematically ensures a portfolio's slow death. The time decay is a guaranteed force working against you from the second you enter the trade. The alternative for buyers is to go deep in the money, targeting the 70 to 80 delta zone. This is known as the stock replacement strategy. These contracts provide massive share equivalence. If you buy an 80 delta call, your contract moves roughly 80 cents for every $1 move in the underlying asset. You capture almost all of the stock's upside. Comparing these options, the 80 delta contract consists almost entirely of intrinsic value. This structural makeup insulates you from rapid time decay erosion. It also creates a massive capital efficiency advantage. You control 100 shares for a fraction of the outright purchase price, capping downside risk. Buying deep in the money options replaces the thrill of a lottery ticket with a high probability directional edge. It mimics actual asset ownership without the massive capital requirement. Buyers and sellers operate in the same market, but they are playing completely different games with completely different risk profiles. Define your posture. Generate a credit as a seller or go long as a buyer. Sellers default to the 15 to 20 delta zone for a structural cushion. Buyers default to the 70 to 80 delta zone, minimizing theta decay as a stock replacement. Filtering every trade idea through this specific map eliminates the extreme tail risk traps of selling, and it keeps you out of the lottery ticket traps of buying. The option chain operates on strict rules. First, a high premium does not mean you found a great value. A high premium is simply the market pricing in a high structural risk of failure. Second, a high probability of winning does not equal safety. If a trade requires massive collateral just to make pennies, the return on equity is too poor to sustain your account against inevitable outlier events. When you align specific deltas to specific strategies, you remove the guesswork. It transforms options trading from speculative gambling into a sustainable, business-like process of capital turnover. Delta is the only metric that forces you to look past the price tag. It makes you confront the absolute statistical reality of your strategy long before you ever risk a single dollar in the market.